Moving along, I am going to introduce my co-chief investment officer, and Scott Fulton, who is going to share with us some of his thoughts as he synthesizes some of the ideas of the day. And Scott, thank you so much.
Thank you very much. Good morning, everybody. It's a tough crowd. Seriously, my subject matter this morning is macro and microeconomics, and I know there are many people in the audience who have way more qualifications than I do in both macro and microeconomics. So my presentation is a personal opinion, and I look forward to a Q&A where I will be facing the same sort of challenges I did in my finals about the J-curve and expectations augmented Phillips curve analysis. But we won't go into that in too much detail. The other point is I didn't choose that photograph. It was a COVID thing about the beard. And I'm going to talk about expectations, but one of the things I didn't expect when COVID happened, and there were very many things, but I didn't expect to go grey at the bottom of my face. I didn't expect, I was told to. And unfortunately, my partner couldn't come because she told me she didn't want to. There's an entire relationship thing which I don't think we have time to right now. So there's stuff about economics up here. We can do Q&A on my relationship if you like. Neither have gone well recently, let's put it that way. One of them is inflating, the other one isn't. Sorry, we have a clicker. I do apologize. No. Well, no, having started that badly, I think we should get on, right? Okay. I approach economics in much the same way as I approached actually studying economics, which is I try to ignore it and use literary references to cover up the fact that I don't know what I'm talking about. It's all about managing expectations, right? The next 15 minutes is going to be interesting. So I'm going to talk about expectations because expectations are at the core of an enormous amount of both economic theory and also the way that we manage our economics going forward. And I think we face a challenge coming out of COVID, which is unprecedented. It's once in a generation, possibly once in more generations. And one of the things that we are about at VIP is not great expectations, is not setting expectations per se, but it's about better expectations, understanding what constructs an expectation and actually how we take that forward and how we work with people so that everybody understands what we're doing, everybody benefits from what we're doing, and that way we can do more work going forward. So a little bit about me. I used to be a stockbroker, so I did used to own shirts with collars and ties. I didn't look like that, but I used to work very close to that point. For those of you who are not in the UK, this is the nastiest PR man in the world. I used to be a PR man, and he was my hero. We can talk a little bit more about that at Q&A. But he invented the word omnishambles to describe the UK government. And finally, just to be clear, and I know there is a Scotsman in the audience, I am Scottish, but for very... Thank you. Thank you. Thank you. So this is Blair on holiday. The last time Scotland qualified for an international football tournament. The ginger wig is not mandatory, just to be clear, but it does come with the hat. No, I am Scottish, and the point about being Scottish, and again, I wasn't counting on the fact there would be an actual Scotsman in the audience, so I'm going to get heckled on this. But the Scots tend to view glasses as either half empty or empty. My next note says consult a lawyer. No, that can't be right. Okay, so necessarily, I was a stockbroker, I was a PR man. Stockbrokers set and manage expectations, sometimes incorrectly, sometimes correctly. PR people set expectations, or as we used to call it, lie. The Scots in me, generally speaking, tends to view the world as a challenging place rather than a place of opportunity. Forgive me, Blair. There aren't very many graphs in my presentation, and I appreciate I'm up against time, but I want to talk about a little bit about oil prices. The thing is, it's the exogenous shock that we see in our economic history constantly, which creates an economic difficulty, which then causes a variety of governments and a variety of economists to try and figure out exactly what we do about it. In the meantime, we're all living through it, and it's our actions which determine the economics that they have to face, rather than what they do at the time. So, just very simply, I'm sure this is not a shock to anybody, but the oil price has gone up. And to that extent, we are seeing an exogenous shock to our levels of pricing and inflation in the economy. And all of the governments that you listen to or read about are trying to do something about it. The problem is that since 2009, all governments have used interest rates to control inflation. And they have been remarkably successful. So just, if I could refer to my notes. In the 1990s, the Bank of England changed the interest rate 43 times. In the 2000s, they changed it 31 times. Since 2010, they've changed it 3 times. But since 2020, between 2019 and 2021, 2022, as of today, they've changed it 6 times. We are seeing, I think, a situation where we have, at the central bank level, a confusion about how we deal with inflation, because we're going back to what we used to do. And what we're facing, I suspect, is a confluence of events which we have never faced before. And so what do they do with the bank rate? We're at historically low levels. We have negative interest rates in many economies. The real interest rate is obviously declining because we face very much rising inflation. Sorry, forgive me. I just want to talk a little bit about the numbers. I'm going to have the Thomas problem, aren't I? I'm sure you don't have any problems, Thomas. But I seem to be having one of them. You can. Can you take that for me?
Okay.
Find another speaker. Point out where I am in my notes. No, you're fine. Don't worry. Don't worry. Okay. So we have a debt problem. And I personally have a debt problem, but I think generally speaking, we have a debt problem. So just in terms of the numbers and the scale, the US and the EU's debts in combined, in both terms, are larger than their GDPs. They have 100% plus gearing. In terms of what we're facing and where that position has come from, the US government spent $5 trillion during the COVID crisis. The EU's combined debt at the end of 22 is expected to be close to 13 trillion euro. That's 3 times what it was in 2020. The UK government, not to be outdone, spent 299 billion in the 12 months to April of last year. Now our government debt, the UK's government debt, is now its highest level of GDP since 1961. Now equally clearly, we've had companies spend a lot of money during this crisis and indeed through the last couple of years. Corporate debt in 2020 was $81 trillion. It is larger than global GDP for the first time in recorded economic history. In terms of who's borrowing that money, in 2020 and 2021, we saw the Chinese economy overtake the American economy as the largest debt burden an economy is facing for the first time again in economic history. We've seen a lot of volatility in the equity market, and I'm going to come back to that. But the equity capital markets, that's where you go to raise money in equity terms. The equity capital markets in the US, Japan, and the UK are all larger by value than the GDP of the country in which they sit. Now, a lot of you may have seen The Big Short, and some of you may have watched it for Margot Robbie in a bath, and some of you may have watched it to try and figure out what on earth a hedge fund does. But the point is that we are in a situation, economically speaking, which we haven't seen since 2008, 2009, and we have very, very different reasons for why we're in that position. But the economic position that we face now is very much similar to 2008, 2009. I wanted to talk a little bit about securities lending, hedging, and the pension fund industry. The total stock on loan currently to hedge funds is valued at $2.5 trillion. Forgive me. It is, sorry, $2.5 trillion in 2001. It is now $2.8 trillion in the space of 12 months. So the hedge fund, or the hedge fund community, borrowed an additional 300 billion of stock in 12 months. That is 6.5% of the value of all listed equity globally. It's 10% of US GDP out on loan to hedge funds. We take pension funds, and pension funds are the fuel that drives the hedge fund industry. And pension funds are huge. The total value of the OECD pension pot currently is $35 trillion, and it's dominated by 7 countries. Now remember, the pension funds are the people who have the money in the stocks, but they have the stock out on loan, and that position is growing. I want to talk about a few solutions, and again, I want to be very clear that this is a personal opinion, but I think there are, thank you very much. I think there are 3 things that we should at least consider. The first of which is the structure of the way we tax our economies. Most of the central banks that I've read about or indeed talked to do not like hypothecation, which, as I'm sure you know, which is where you raise the money to spend on the product or the industry that you're going to develop. And you raise the money by people using that product, or at least telling them they have to pay when you build it. In terms of what I see central banks and indeed governments doing, is that we, in the next 12 to 24 months, are likely to see bond issues at a sovereign level, so gilts, T-bills, etc., which will try to rebuild the infrastructure. I think we have a classic opportunity, both emotionally and economically, to do this in Ukraine. And if the Ukrainian conflict does end, and there is a rebuilding mandate to be done, it is not beyond the ken of man that the EU, or the UK, or the US raises money for its population to rebuild Ukraine. A clear example of hypothecation, and if that works, and we have a mountain of debt to repay, I think some central bankers and policymakers will consider that going forward. We may see at the end of the criticism and the obstruction to hypothecation. I don't know how to turn on a television. That's pretty obvious from this, to be perfectly honest. And I certainly don't know how to use blockchain or mine for cryptocurrencies. But one of the things that struck me when I read about it is that blockchain is really about a more efficient banking system. I get the point that it's about transactions, and I also get the point that it is global. But I don't know if any of you have tried to transfer money recently between bank accounts, between countries, between bank accounts. I am trying to contain my enthusiasm for the international banking industry. It hasn't been easy, is a point. And one of the reasons why it hasn't been easy is trust. We talked about trust yesterday. Anti-money laundering is a thing, apparently. I don't know how to launder money. I have no clue how to do that. I don't even know what laundering means to that extent. However, I've been unable to pay things because apparently I'm in the process of potentially laundering money, and my bank, who's doing a service to me, has stopped me doing that. Now, I'm fairly clear when I used to work in the markets that banks can put money on overnight rates on a 24-hour basis and make a return. Some of the highest overnight rates in the moment are sitting in Southeast Asia. So while I've been trying to pay our staff and our people, my bank has been making a bucket load of money in Thailand. Now, back to the point. Blockchain, I think, will be a massive advantage to both bank users and the banks themselves. We need greater transparency. We need the ability to transfer money across borders, across time zones. And we also need to be absolutely certain that it's going to turn up. Expectations are essential because we work with people and they need to know that we can do what we said we're going to do. Everybody needs to know that. So I think blockchain is going to help that. And I think we're going to come through that in the next couple of years. I was going to talk a little bit more about shareholder returns, but I am conscious of time. One of the casualties of our perhaps obsession with the equity markets and the debt markets has been the slow death of dividends. Traditionally, we had pension funds in the United Kingdom, for example, who relied on dividends. It was the way they generated the return for their investors and for their pension holders. And to a very great extent, we saw the death of this dividend or the reduction of dividends as companies came to the market being told they could be valued on revenue. They could be valued on how much money they spent on capex. A variety of different value triggers, but none of it about dividends. Now, the pension funds still have the same liabilities. So they had to find another way of making money without selling shares or buying them back on a regular basis, which incurs tax and cost. So they lent their shares to the hedge funds. The hedge funds provide collateral, typically valued in the context of a dividend forgone. Pension funds make money, the hedge funds have stock they can sell. But as a function of which the volatility or the beta of most equity capital markets, with significant pension funds sitting around them, that beta's gone off. It's very much higher than it was 10 years ago. Now, the point about a beta is, when you get down to valuing a company as an analyst, you use the weighted average cost of capital as the benchmark. The beta drives your weighted average cost of capital, particularly for companies with balance sheets which are more than 50% equity. So in just simply saying I don't want to pay a dividend, we have raised the barrier for how we value a company. They go onto the equity market, they tell everybody they're going to do what they want to do, they don't pay dividends. The very pension funds who have encouraged them to do this then lend their stock. When they don't meet the expectations they set for themselves, the hedge funds sell the shares. So what can we do? I've talked a little bit about this, but I think governments are going to be more creative about how they tax. We have to go to tax. Monetary policy is not working. Interest rates, to be very clear, the biggest debtors in the world right now are the governments, and they all face interest payments. They are also in charge of interest rates. So if they continue to raise interest rates based on, for example, economic theory or purchasing power parity, or just simple monetarism where you would raise rates to combat inflation, you're also raising the cost of the debt you just incurred through COVID. So there is necessarily a barrier for governments going through the monetary route. I think they will use fiscal policy, and I think there will be more targeted, the hypothecation that we talked about. In terms of trade, we've got to do something better than we currently do. Blockchain is going to be a component part of that. International trade has to ramp up. It's going to have to ramp up in a more transparent way, and I think blockchain is going to be a core component part of that. And I think in equity returns, I think we will see the return of companies paying dividends. If I could go into Boohoo, which is a UK retailer, which is the most shorted stock in the UK, and tell them if they paid a dividend, they could reduce the amount of shorting going on in their share price by about 25%. I'm fairly certain there would be a different conversation at the board when it came to looking at the annual returns. So in closing, because I need to drink a cup of water, as you can probably tell, What does it mean for people who make money? I've met more entrepreneurs in the last 18 months than I've met in my life. You are fabulous people. You are optimistic. I'm going to make that point. The equity market's not an optimistic place. Generally speaking, works on avoiding disappointment. That is about as positive as it gets. But as entrepreneurs are optimistic, you need to be able to deal with the less optimistic markets where you may need to raise capital, may need to engage. So I'm just a couple of things. Firstly, work backwards. The equity markets and the debt markets are all about your ability to pay, not about your ability to grow. Growth is simply the process through which you generate a return. So if you find out what returns they want and work that back through your model, you will have a more constructive conversation. Be choosy. Not every capital provider is the right one for you. And you are, to a very great extent, not simply a price taker. Any entrepreneur can choose which money to take on what terms and over what maturity. So to that extent, the first person to turn up with money may be the right person, but I would ask some questions before you do that. And manage your own expectations. I appreciate I started off by saying I'm Scottish and therefore almost preternaturally cautious. We've been cautious, excuse me, we've been cautious since 1975 and Rolls-Royce, and it doesn't get any better than that. But you should manage your own expectations. Set them realistically. Be optimistic by all means, but also prepare for disappointment. And finally, I used to have this on my desk when I was researching building companies because they paid dividends and had earnings. The turnover is vanity. Profit is sanity. Cash is king. We are going back to a cash world. We're going back to dividends. We are, to a very great extent, going back to the 70s. It just so happens I have the very wardrobe for that. Thank you very much.
I have just one, maybe to kick things off here. You know, growing up in the kind of technology kind of stock 1999s onwards and stuff like that, it's true that you know, we were kind of implicitly told that companies that paid dividends were not growing. They were like mature, they were established, they were yesterday's news and so forth. So there's either a communications challenge or an education challenge and so forth. So, you know, when you've shared some of these ideas with me before, I've thought, you know, that's fascinating, the circle. Why do you think that more people don't go all the way to the end as you've done? You've gone all the way to the end to help explain why things are happening, what are the different optionalities. Why doesn't that happen? You know, this is probably, I don't know, just really quickly, how many people in the audience would say this may be the first time that you've heard that about dividends? Couple, okay. So, Scott, yeah.
Okay, thank you very much for that. I mean, I think Julie's absolutely right. I mean, if you look across any research department in an iBank right now, you will have sort of three main camps. You will have traditional, almost investment trust-like equities, which are stable. They will be owned by pension funds, which have 30-year liabilities, and they, generally speaking, generate cash and pay dividends. But they're not exciting, and you'll be unable to explain them to your 25-year-old daughter when you go home. It does what? You know, it doesn't make clothes or design an app or something. I'm now sounding as if I'm 103. I apologize, but that is where they sit. There is another group of equities or companies in there which are trying to transition from that position. And you have almost like the 65-year-old who turns up to the wedding and starts to try and dance to something which was recorded when he was 64. They are struggling. In terms of the point that Julie said about the expectation situation, it's very difficult for a company in the equity market right now to transition from being a stable holding, where you go for your dividends and your income, to being a go-go stock. And there are very many who have tried and failed, and very, very few have succeeded. And then finally there's the go-go stuff that's listed in the last 10 years. It's listed on revenue, it's listed on concept, it's listed on brand, and it's listed on this is a great idea and the market's going up. Now, to that extent, when we have an exogenous shock like COVID or like the war in Ukraine, there is no valuation mechanism which says where's the floor for that share price. So when we're in a situation where we have another quarter, I think we're in a bear market, probably in a bear market now. And bear markets work on floors. The floors for equities have traditionally been either cash generation from the balance sheet through the cash flow in terms of cash flow per share. So there is the potential to repay shareholders through a buyback or another return, or it's dividends. But if you're valued on revenue at that point in the income statement and your balance sheet contains more debt than it contains equity, your cash flow is a promise rather than a reality, you have no floor. And you can go to the moon, and these stocks have done. But, for every FANG, there's a whole lot of toothless people out there going, I was going to make £3.50 in revenue, I'm obviously worth $14 billion. We test these valuations in extremis, and I can't imagine a more extremist set of circumstances that we have currently.
Now, you also shared with me recently, which I found personally wild, that the equity capital markets compared to the GDP in Europe, or maybe it was just France and Germany, was like 70%.
Yeah.
And was it double in the United States,
Yeah.
or triple? Yeah. So I wasn't aware of that relationship between the equity capital markets and the GDP. So that was super surprising, but it explains a lot. Would you say that there's a right ratio, or that it's the right ratio per country, this relationship between real economy and the financing of that? Would you say, would you personally, with your Scottish pessimistic, which I don't really believe, by the way, but go for it if it's working for you today.
I'll wear a kilt to anything, seriously.
Is there a right ratio between that?
I think there is, but we have to look at the nature of the economics and the nature of the ECMs that we're talking about. So America's equity capital markets, be it NYSE or NASDAQ, are destination markets. The reason why the total value of the American ECM is so much larger than its GDP is because there are so many non-American companies listed in America. It is a market you go to because it is full of cash. It has a social situation where 401ks have to be put into something. There is a Merrill Lynch on the corner of every main street, and there is an equity ownership culture. So necessarily, if you need to raise capital, your first question is, how do I get to the United States? Not which market do I choose. I think the other point about the French and German markets is the French and German economies and industries are they are slightly longer term in their planning. They are far more structured in the way that they own their companies, and I think they take a far more conservative, with a small c, view of balance sheets. So while French and German equities are not massively a multiple of the French and German economies, they do tend to have fairly significant debt holdings, and they manage that on the basis of their cash flow. So what I would suggest is that the French and German equity markets in the context of their economies are more the ideal than it is the US.
Kimberly has a question, so we'll just get her. After Kimberly's question, I want you to make a comment about Greece and what you see.
I'm just wondering if you can comment on the private markets rather than just the public equity markets, and do you believe the same criteria apply in terms of what investors are now looking at and measuring for investments in the private markets?
Sure. Thank you. Just to make my position clear in terms of that question, which is a great one, I've spent less time in the private markets than I have in the public markets. My impression of the private markets over the last 2 or 3 years is that they fall into two camps. The first is that there is a necessary exit, and that will be the public markets. And the valuation metrics, or a trade, indeed, yeah. So you're exactly right. There is an exit, and so I've seen two sorts of companies. One set of companies is managing for exit, and that is a constant beauty parade. Do I look great? Do I look so great that I'm going to get a multiple of revenue when the corporate buyer or the banker tells me I can list in New York? But there is a second set of companies which I find far more interesting, who have no desire to go near a public market. I mean, these companies have figured out that if you go and list your equity on an equity capital market anywhere, the people out there who own your shares have the right to come in and check whether you've got the right oil level in your engine every month. They can ask you questions in a public forum about how much you're paying your finance director. And I don't want to go into too much else about finance directors, but it is the level of scrutiny that you receive as being on a public capital market. I don't think very many companies are prepared for that. There's a company in the UK which listed during COVID, which is called the Hut Group. It occupies an enormous amount of newspaper ink and social media commentary. I don't think anybody who's writing about it knows what it does. And it listed multiple billions. It was the biggest listing in London that we've had for years. Its share price has cratered. And throughout that process, nobody knows what it's doing. And yet the chief executive has been pilloried. National newspapers, broadcast TV, radio, social media is a mess for this guy. And all he did was build his business and list it on equity capital market. We have a tall poppy situation. I mean, it's less so in the US than it is in the UK, but it still exists. And so I have a remarkable respect for those companies who say, I can do this privately. Now, I think to the point you were asking is that obviously the private market has different structures as well. There's private equity, there's venture capital, there is bilats with family offices, etc. I think all of that is still having to come to terms with the exits are now starting to fall away, and that these people are not just a necessary provider of capital, but they may be the provider of capital for the next 25 years, and you will stay in private hands on that basis. Managing those expectations is a conversation. It's not having to use national newspapers or go on TV, or for the love of God, have a Twitter account.
Well, enter the Mittelstand, right?
Mittelstand,
Right back,
exactly,
right back, and so forth. So you made a comment there about the weighted average WACC and the relationship there, and we think many of the people are going to be speaking about the mobility industry. David's going to be on stage here in a couple of minutes, and he's an expert in that. And we've got Richard and electric vehicles. Certainly, one of the models, I think, the number of times that Elon Musk's name comes up in a conversation. If you talk about, it's crazy. Every week, I think, wow, it's like 50 references to him during the week. And he's inked a model for the new electric or new mobility ecosystem, right? Yeah. One company was tough and he did it. Uber, Tesla took advantage of an incredibly low cost of capital, which probably they don't even recognize how much they were a beneficiary of that, right?
Yeah.
And yet, and so the fact that that's gone or going, and the fact that they had that ability to get into the game, they broke through the production, the capacity, they've made it now. They're into being these large networks and platforms and so forth. How does that change? How does that create a barrier? Are we in a situation now, if we're looking at the Davids and the Goliaths, the challengers and the incumbents, that the empire is striking back? It's for those of us who invest. I know Jack is here from Silicon Valley. He invests, as he said, in early stage companies, and other people do too. Is this the right time to be investing in early stage companies, or this is the time to be working with the large companies and hoovering up the small companies that are out there in the oceans?
I mean, excuse me, it's a great question. I think that from an economic longevity point of view, it would be the former. I think we need to encourage new blood, new thinking, new listings, and to your point, Kimberly, people who don't necessarily have to use the capital market where you're going to appear in the Sunday papers on a regular basis. So I think that we should encourage a multitude of new companies. I think that the point about the roll-up model is that necessarily, Elon Musk is someone who is constantly challenging every single structure that he faces, but he has provided a very, very significant challenge to the public capital markets, because you don't communicate your profit expectations via Twitter, or at least you didn't until Elon Musk turned up. You don't say you're going to buy a multi-billion-dollar listed company via Instagram and then not do it. I mean, again, there are people in the SEC who about 3 months ago had hair. Now they don't have hair and are on Valium, simply because Elon Musk has taken to Twitter. But he's making good points. The issue is that we were hidebound going into where we are now. I sound a little bit like, a 65-year-old. If only they paid dividends, I would invest in the Prudential. I get that. But the point is that we have a fundamental disequilibrium. The capital markets see the world one way, and entrepreneurs and companies who need money see it another way. And we have a tail-wagging dog situation. The equity capital markets are servants to corporates and entrepreneurs. They are providers of capital. They don't do anything else. They don't come up with ideas. They don't slog around I don't know how many different offices and try and raise funds. They don't do the marketing. They don't put the time in and the capex in terms of the R&D. They are simply the providers of capital. Now, I used to work in that market, and I've never created anything in my life, so I'm a little bit hypocritical. But there has to be a shift. Corporates are going to have to take the bull by the horns. The equity capital markets are there to serve them. If they don't like what you're telling them, and they don't put the right value on your metric that you use to value your company, then to Kimberly's point, there are many, many other routes out there. Simply being on a public capital market, it's not winning a trophy. It is simply getting into a relationship which you don't understand in many, many cases, and they will criticize you frequently. I think that choice is something we need to be talking to people about.
Maybe the last question, unless there's one from the audience, is around Greece. And we've obviously made a bet on the future of Greece as an economy, and Kia as an island, and so forth. How do you think? So this, we've got some wonderful people here from Israel, Startup Nation. How do you view Greece as a startup and as a stock?
Yeah. So my view on Greece is that it sits in the zeitgeist, because we are not going to work from home forever. I know some of us want to. Some of us work for PwC and are getting whiplashed back to our offices. But the thing is, there's going to be a hybrid method of working. We are going to be more connected rather than less connected when we come out through this. So our choice of location is not going to be proximity to a tube or a train or a great cab service. And it's not going to be because the Wi-Fi works in Hampstead because it doesn't work in Wimbledon. If we assume universal connectivity, and we also assume that we can do what we do from anywhere, then Greece is arguably ideally placed to deal with that. From another point of view, in terms of if we go the revenue through to cash flow, Greece has got an approach to corporate development through its fiscal and monetary, certainly fiscal policy, which is productive. Rather than seeing the corporate sector as a cash machine, which you can raid every other Friday night to pay for what you've done as a government, Greece has got a far greater partnership approach to it within the EU. I mean, having that conversation with the ECB is never going to be easy. But the Greeks have had that conversation regularly, frequently, and they have had successes. So people coming into the EU, to your point, I think, the landfall should be Greece. I'm not for a minute criticizing Germany or France, but I am British and we have some history there. Greece, okay, 1821. All right, okay, fine. It's a long time ago, and Byron did die for the cause. But the point is, if you're looking to make landfall in the EU and you're not currently in the EU, there is no better place to do that because you have a partnership. If you make landfall in France, you make landfall in Germany, you make landfall in the UK, which is not even part of Europe anymore, you will face a wall of institutions and thinking which does not reflect where we are today. And I think Greece, that's my point. Greece reflects where we are today. It is a positive partner rather than a series of questions which they know you can't answer and they know you don't want to do.
So I could talk to you for forever, as you know. So thank you so much for your sharing your thinking this morning with us. Thank you very much, Scott. Really appreciate it.